For everyone in the room and also joining us remotely, good afternoon. We're talking about a very relevant debate. Many people say the mineral sector is going to grow, demand is not their problem, it's all about supply. When we ask miners, they say the money is actually not really coming and the shareholders don't really value our long-term projects. When we talk to shareholders, they say it's all about growth. When we talk to customers, they say they need new metals, they need green metals. But when we ask the mining companies, they say they aren't paying for those metals. That's why we're having this debate today, to ask about the misalignment of expectations among the different stakeholders in this ecosystem that has to develop the mineral future. Joining me today, we have Frank Gustra, President and CEO of the Fior Group, Jeff Curry, CSO of Energy Pathways for Carlyle, David Oram, co-founder and director of Sandstorm, the Honorable Frank Fanon, MD of Fanon Global Advisors, Mark Christoph, CEO of Traxys, Munia Boussetta, Senior Fellow of Policy, Center for the New South in Morocco, and finally, Dr. Gracelyn Bhaskaran, Director on the Critical Minerals at CSIS. We're going to do this debate pretty interactively. We're going to give each person a maximum of roughly 30 seconds to give an answer. We're going to go rapid fire style to get a lot of different views here, but also having everyone kind of try to build on each other. As the moderator, I'm going to basically tell people that their time is up and we're going to switch on to make sure we keep it lively and exciting. So we're going to start out the first question. We're going to start at the end and kind of go around. First question, do you think that the capital markets have the appetite for long-term growth by mining companies? Yes or no?
Mixed.
Say more.
Well, I think capital markets, and I think you in your framing, you mentioned the drive, but the lack of capital that's actually being deployed. And I think that is true, but it's fragmented regionally based on the extent to which there is true long-term thinking, which does not align with an investment cycle, particularly in places like London or New York.
Okay, David?
Yeah, I'm kind of a hard no on this, especially from where I come, which is really developing that pipeline. Exploration, development projects, early stage projects. The market is really kind of all but abandoned them because of that short-term nature of how the capital markets really look at the space today. So trying to get, we talk about building policy to trade these things. We have not got a pipeline to find those next projects that are going to be part of that energy transition, critical minerals part. And we're really in dire straits of figuring out how to finance that early stage speculative risk capital that has always been part of the public capital markets, but now has really left the space almost completely.
Okay, Gracelyn, what do you think? Do you agree?
Yeah, there's a lot of tension between long-term national economic interests and short-term fiduciary responsibilities. We see this with the EV industry, which is the biggest driver of base metals demand, and people aren't really buying EVs in a number of markets, and auto companies are really struggling. But we forget that China, between 2009 and 2023, spent $230 billion on subsidies. So ultimately, it's not a sector that grew on its own with that fiduciary responsibility, but through state support and long-term vision.
Munia.
Yes, okay. For me, it's quite a complex situation to balance between stakeholders' expectations or demand, also and requirements of ECG. But I think one factor we have to consider is how the market is evolving, particularly critical minerals market, and how is the size. And what we have, all perspectives show that there is a great need depending on how the energy transition is developing in different countries. So for me, the market is there. Certainly, there is some conditions, there is some challenges we have to tackle, but one fundamental thing is just the market is growing, and we have many indicators that are confirming that.
Perfect. Jeff?
Well, I think we can clearly say the market's failing. It's not providing the capital, and the question is why? You can see the story, but they don't act. And the reason is the myopic nature of capital markets. They're dominated by passive players who can't hold a position, algos, momentum players, so on down the line. Because they can't hold the position, they're not involved.
Great.
Well, I agree. I've been doing this for 40 years, financing mining companies in the capital markets. I've never seen anything so bad as what we're witnessing today. And I think it has a lot to do with investor sentiment around ESG and labeling mining as a dirty business without understanding. These are the same people, by the way, that believe in the energy transition, and they haven't connected the dots yet. You need these minerals. They don't fall out of the sky. And I think it's partially a marketing issue and a PR issue from the mining industry that needs to be remedied.
Mark?
Yeah, I think from a Western perspective, the capital markets have been broken for 10 years. You've had no formation of equity, you've had no debt availability, and it's had to have been provided by private companies that are in the business, and that's not sufficient to build the infrastructure that we need to service all the raw material requirements. And that's going to linger. We're seeing alternatives, examples in China, where there has been significant support, perhaps subsidy, to help the development. So it's not a fair fight.
Perfect. And maybe to build on this, just to kind of go around, I think it'd be good to also kind of assess, for this group, if you think about how that can be solved, if the actual practical solutions, maybe, if everyone wants to pick up at least one part of the ecosystem, governments, companies, financial investors, what would actually unlock that growth? Maybe starting with you, basically, David.
Yeah, so I think a lot of it comes down to timelines now that it gets to take programs off the ground. We're finding ourselves as exploration companies stuck in just burning our money in working capital rather than putting it into ground to get actual tangible results out of it. So with the tie-ups and permitting, the issues around even just getting those initial first drill holes to find that next project, that's the real struggle where we sit. Having some more transparency about how that permitting process works, being able to effectively communicate it to those capital contributors is going to be really key. And if we don't get better participation, I think what we want from governments as the groups that are trying to finance those next mega deposits to be discovered is just to have that transparency and smoothness to be able to get the permits and put that work and money into the ground. A very valuable capital that is seldomly available.
Perfect. And maybe, Jeff, looking to you, given your financial background, how would you basically play the role on shaping the perspective and improving the perception of the mining industry in the financial community?
I think it needs to be a focus on ROE. And right now, there's focuses on things like levelized cost of energy and other factors that are not the focus of profitability. So that's one. The other one is there needs to be a focus on functionality and usability. EVs are losing market share because customers don't like them. Range anxiety and other factors, they're preferring the hybrid. So I think we need to focus on the usability or the functionality.
Perfect. And maybe Mark, Christoph, you basically rose the point around circularity and how circularity isn't really the solution necessarily to a lot of the questions. Maybe you want to talk a bit about that, because obviously, when you look at popular debate, everyone's always saying, oh, well, if we just recycle more, it's going to solve the problem. Basically, we don't need a mining industry. How would you kind of try to shape the perspective there?
Well, I think as it relates to critical minerals in the EV space, you don't have enough critical mass today to support a robust recycling program. If you compare it to the aluminum industry, the stainless steel industry, you have very robust developed recycling solutions. The lead acid battery is a fantastic recycling story, but it'll take some time to get to critical mass. And recycling a lithium-ion battery is not an easy process. It's a hazardous waste product that you need to process carefully. You need a hydrometallurgical or a thermal process. So it's a developing market, but it's not the solution for tomorrow.
Okay. Maybe to build on that, and maybe looking to Graceland, there's a question about who pays for the energy transition. I'm going to give everyone a chance to kind of build on this. But this was a topic you want to talk a little bit about, given that you have consumers, particularly on the consumer electronics side, saying they want high recycled content, building on this conversation about recycling. High recycled content, they also want green metals, but they don't necessarily always kind of pay for them. So maybe you want to talk a bit about that, and we'll kind of pass it around to the group.
Thanks so much. We need to level the playing field. You know, China's had this decades-long advantage in terms of integrating minerals into their industrial strategy and foreign policy. And it was heavily subsidized. And now what we're doing is we expect Western companies to be able to come in and compete cost competitively, and it's not going to happen. So the question is, to level the playing field, what do we need to do? And the reality is that the market, the consumer in China did not pay the full price of what we would call the transition. In fact, if you think about it, the energy transition, you know, in a period of political change, we have a new sheriff coming into town in a week, is really an economic competitiveness argument. It is the domestic auto industry needs to remain competitive for investment and for jobs. So ultimately, what the state needs to do is to provide the support to ensure that our auto industry is competitive, which is the same thing the Japanese did in the 1970s. They supported a nascent industry. And given that EVs are driving about 75% of base metals demand growth by 2030 and about 90% in the 2050 outlook, it's going to require more support than we've given the industry to compete.
Okay, so maybe passing it around, Muria, you want to comment a little bit, like who's going to pay for the energy transition?
Okay, that's a very interesting question. And if you consider African markets, and I'm very interested about what is happening there. So we see that in this situation, we have also the impact of local communities. So the balanced situation should consider consumers, shareholders, but also the impact on local community. And we see during these 2 days the debate that was a raise of awareness coming from African countries to see how we can generate more impact by investing in mining. And that is, for me, it's very important, and that can create shifts in investment relations and how we can really generate the win-win situation. And that means that we have also, that states should be prepared for that. They should create good condition for investment and have a vision, priorities, a selective approach. So for me, it's a new model of investment that should be engaged with countries. But at the same time, there is another shift that we didn't consider in our analysis. It's shift coming from technologies. Because what you said about technology, it's very important. Before 2080, solar and wind wasn't competitive compared to fossil sources. Now it is a reality. And we see that in different countries in Africa, they have generated electricity by solar and wind, which is very, very competitive. And we know also that after the war, Russia and Ukraine, that the green hydrogen wasn't on the table, but now it's considered as a serious alternative. So in different scenarios, it's important to see how the technology will impact in the cost and how that will change the reality on the ground.
Maybe to put the question to you, Frank, if you think about the situation in which oftentimes lower carbon means higher cost, how do we pay for that?
I think the consumer is ultimately going to pay for it. And I think one of the things we need to just be aware of is that ultimately we're all aware that there's a deficit of certain minerals, and at the end of the day, the only thing that's going to remedy that is a higher price for the commodities, and that means higher prices for consumers. And so I think that the consumers are going to drive the demand for minerals, and that in turn will drive investment towards minerals. And at the end, profits is what drives everything. I don't think that the Western capital markets have woken up to that fact yet, but I think that higher prices will.
And if we look at prices today, for some of the commodities, they're quite low. So maybe just passing it over to you, Frank, basically a little bit on if prices are on some level so low, yet the expectation for growth is so high, how do you manage that if you're a lithium miner today and you see where prices are?
Well, I think you have to start explaining, well, why are prices so low? What is the behavior and who's behind it? This goes back to this concept of the market itself, and I would like to challenge that concept when we're talking about some of these effectively niche metals in which there's no liquidity in this market. There's no price discovery. These are trades that are done kind of bilaterally. And so what is price discovery, and what is driving down price, and how is that market being manipulated or controlled, right? So, we talked about China, you talked about the dominance of China, and it's very rational, and they're not investing because of return expectations in many parts. They're doing it because for the security. And this whole energy transition conversation, I think we kind of jumped ahead. I think it's important to define what it is. Energy transition would suggest to transition away from energy in which countries like the United States are abundant to those in which they're reliant on someone else who's producing it. And I think one of the changes is, of course, we're a new president coming in, and they're talking about rebalancing of that, prioritization. So when it starts talking about, well, what is the price? What is the real input costs of that production relative to a Western producer or someone who's trying to build a lithium mine in the United States compared to a lithium producer of an SOE working elsewhere? We need to have true understanding of what are those inputs and how do we have a levelized cost. And only until then will there be this other issue, which Frank spoke about in terms of the ESG component. That is completely asymmetrical in terms of ESG issues and protesters in London or New York or Melbourne versus elsewhere. So I think we have to start looking at what are the real costs and far beyond issues around emissions. And I think they can be monitored. If companies want to sign up to pledge to track the emissions of invisible gas through their supply chain, they should be able to understand what are the real environmental and human costs associated with their business, and only then will we be able to start levelizing true costs and have some degree of proper competition.
When you really kind of talk about this idea of, I think, control or this supply chain, or somebody's really kind of trying to control the price, like in the end, we on the mining side of things, we've been pounding the table for years now about how the problem with supply and the problem with loading that pipeline with projects up. So it's not like this is some kind of secret discussion we in the mining industry are having behind closed doors about this. We've been standing there with a bullhorn trying to tell governments, trying to tell consumers that there's a serious problem for coming up with the supply. But why are we not getting long-term, that's not something that's getting manipulated by government or current buyer of this. Why aren't speculators of the commodity, why aren't they coming in thinking about the long-term
I'll take that one.
Yeah.
Where are the specs? And I think it goes into the regulation sitting on the banking and financial side. They can't hold the position. They will not buy longer dated contracts. And I think I like to use the example of oil in the 2000s. We saw China out there. We knew there was a problem. Oil trended up over that time period. You attracted capital, created shale, problem solved. Why? There were speculators and investors in oil. Let's take what happened in Newcastle coal over that same time period. We knew there was a problem. There was no speculator, no investor in coal. It sat there at very low levels. Finally, around 2009, 2010, went straight up, much higher than oil. We're set up for the exact same problem in the minerals sector. But I think in terms of getting the investor back, it's going to require changing the regulations. I think we're beginning to see that happening, but I think right now you have a domination of passive investors, momentum players, who will not hold a position in some case for more than 15 seconds. And I think that needs to change if you're going to get the speculator back.
So I think we need to recognize the elephant in the room, and it's China. And let's be clear, China dominates this market. They want to continue to dominate this market. And someone talked about manipulation, and certainly happening in the nickel market, and keep competitors out of the market. They suppress the price because they have a lower cost of production. I don't think President Xi wakes up every morning worrying about quarterly profits. And so when you, in the pursuit of either momentum or quarterly profits, that doesn't align well with someone's long-term geopolitical strategy. And that's what we're facing. And I think, again, the only thing that's going to solve it is higher prices.
Yeah, we're in the business every day. So I'm transacting through Traxys, all of these products every single day. We've never run out of anything. It's all about price. And price will bring profitability, which will bring investor capital. But to look at a retail investor participating in the commodity thematic around critical minerals, they can't do it. There's no product to buy. They don't want to put tantalum in their garage, cobalt in their garage. There's no way to really express a view either. But price will ultimately drive supply side, but the price hasn't been there. The market has spoken. If you look at the price deck on lithium, cobalt, nickel, it doesn't justify additional capital investment today.
And maybe if you're sitting in the shoes of a mining CEO, maybe just to build on this idea, you see that most people are fired as mining CEOs because of bad capital projects, right? So, and right after commodity prices go down, you're ramping up, it's going to be even a worse market, you get fired, right? So maybe to talk a little bit about this, that's that long-term view you need, and then also even the leaders involved are not rewarded. So maybe a little bit on how we can get the longer-term kind of price views up to actually promote that kind of investment. Is that possible under the existing system, and what would have to change on the regulatory front?
Well, you can't get they have the longer term price view. I think everybody around here is bullish. The problem is you don't have any mechanism to be able to lock that price in. And the reason you don't have the mechanism is because following Dodd-Frank and a lot of the regulatory changes that happened following the GFC, we took away the mechanisms that allowed the liquidity on the back end of these curves to exist. And because there's nobody to take the other side of the trade, no liquidity out on the back end of the curve, you can't lock that in, you can't guarantee the investment required. I like to say, long-term markets solve shortages, spot markets solve surpluses, and we have spot markets. The problem is they solved a surplus in the latter part of the last decade. We now have shortages. We need long-term markets, but we don't have the regulatory framework for long-term markets.
Yeah, you nail it right on the head. Like, that's the biggest issue. This is a generational industry. It takes a generation to really find, discover, permit, get these projects ready for building, and then you want them to be able to run for generations. So in the end, if you don't have long-term capital available to you, how can you do it? And every day, it seems like the market gets more and more myopic on just really the tiny little details that are going to steer copper price up or down, which is whether or not China's having a good day or a hiccup on that day. And that's the frustrating thing, I think, from us who are trying to develop those things, is that there's very, very few pockets of long-term capital and less every single day.
Yeah, maybe Graceland, please.
I mean, you need patient capital, but you also need strong long-term demand, right? I mean, I look at China last year, they spent $45 billion on subsidies for the EV industry, which is the biggest off-taker of a lot of these base metals. But at the end of the day, China's economy last year was its second worst year since 1991. You had a property sector go bust. The IMF released the outlook that the economic risk is all tilted to the downside, but China was still spending on making sure that long-term demand was there for EVs and base metal offtake. So one of the challenges that we have in the US, but broader, is that the long-term demand signal is you have a market surplus of a number of these base metals, right, cobalt and more, because China is ramping up production. But we're not seeing the offtake agreements. There's this uncertainty and hesitancy where when I even do have, financing available even via governments, it's like, but they require an offtake agreement, and it's not the market for those. Ultimately, the defense industry is vital, but most defense, companies will tell you they're not going to be the big off-taker of these metals. They buy bespoke quantities. They're building, 300 satellites, not 30,000. So we're also in an environment where the long-term demand signals are quite wobbly, owing to geopolitical considerations, economic considerations, et cetera, whereas China is giving that demand signal in spite of its kind of short to medium-term economic challenges.
Yeah, and really that volatility in pricing creates a situation where the capital's not going to form, and you're not going to have visibility. There's also been a shift in the 35 years I've been trading these products. The long-term contract doesn't exist anymore. The market is migrated to a spot. What's the price next month? That's long-term today. So it's a much different dynamic. So when the spot price is manipulated, sometimes pushed down, it disincentivizes future investment.
Okay, so I think we've all blamed capital markets a lot over the last 20 minutes. Maybe just to, this maybe turn the view a little bit on the miners themselves. You could sit there and say, actually, the capital markets are not rewarding them because their CapEx is always completely over, significantly over, it's delayed, and basically, at the same time, they have a lot of permitting challenges, which really delay their ability to realize the projects. So how much of this is actually the mining players looking back and blaming capital markets when it's actually their own fault? I'm going to start with Mark, maybe on that, and maybe we'll kind of go through.
Listen, a CapEx blowout makes every investor upset. And we've unfortunately seen too many CapEx blowouts, particularly in some of the critical minerals. And there's a lot of examples in the lithium business. We bought a bankrupt asset, Nemaska Lithium in Quebec, and it was mismanaged. They didn't execute on their business plan, so that's going to also disincentivize investment in the sector.
I think mismanagement is a big part of it in our industry, especially in Western-based junior capital markets. We see so many great projects that are poorly budgeted and mismanaged and then have obvious cost overruns and delays and also. Permitting is part of the process. The uncertainty around permitting always delays and increases the cost, but it's also mismanagement. So that is, the industry is partially to blame.
I don't think it has anything to do with metals and mining sector. It's capital-intensive sectors more broadly, or let's call it old economy. They're trading at substantial discounts to the new economy and the tech that are asset light. And I think that is what needs to change going forward. And that's going to require a substantial shift in the investor focus. And the term, like I say, it's revenge of the old economy. We've seen this playbook before in the 2000s with the dot-coms. In fact, the analogy between internet, dot-coms, and AI in the world we're living in today is very similar. But eventually you run out of this and you see the spiky prices, the volatility becomes overwhelming.
Yep.
Investors shift into the old economy.
Yeah, I think one of the issues too is just the ability for the mining industry to adapt to a whole new environment of really what the capital markets look like today has been very poor, which isn't surprising because that's really been, I think, a little bit of a lack of sophistication, especially on the smaller size companies in terms of regards to financial ability on it. So for sure, that's going to be a big issue, but we can't forget just really about the timelines that have been placed in front of so many of these mining companies. Like, how do you manage an enormous working capital to get projects into place when there's so much uncertainty on the permitting side and so much lack of support from most governments to be able to really kind of move these forward, to give certainty on timeline as to how you do this. Trying to juggle all these things, how do you not get a CapEx blowout on this when you're really spending so much time thinking about how this permitting, how these issues are affecting your working capital spend on this as you wait for the steps, the approvals to be able to get these projects into production?
Perfect, Munia.
Yes, of course, public partnership, and we talk about governments, how we can create conditions to enhance relation between public and private sector. And I think that is very important, particularly when we are in emergent area like in African countries. We need to set environments to create real ecosystem that enhance the resilience, enhance the competitiveness, and that may attract other private investments, particularly in industry, logistics, services, R&D. So that's when we create all the components that could enhance, as I said, resilience, that certainly creates more condition, competitiveness condition, but also it's give more confidence for investors.
Perfect.
I think, a CapEx blowout is it's a double-sided problem right now, right? Because you have things like social license to operate. We're sure mining companies can certainly do better in places to ensure mines aren't being interrupted. But at the same time, nobody could have seen 5 years ago probably that BHP would need to put a nickel mine down and Glencore would need to put a nickel mine down in Australia and New Caledonia because we didn't see the market volatility that would be generated by Indonesia's rapid ramp up of nickel. So it's a dual, there's some things mining companies can control, but as a whole, it's a perfect storm in the industry in terms of, incentivizing capital formation to move along.
Yeah. Frank?
Yeah, I would just like to reflect on kind of going back to places, focusing on places like public-private partnerships, investing in emerging markets. I think that's where one government, particularly Western governments, have a meaningful role to play, because the reason why some companies, particularly Western investors, Western mining companies, have a reluctance to go to certain jurisdictions because of actual perceived political risk. Having a partner like the U.S. government be a co-investor alongside helps to address that risk premium, if you will, which also is a deterrent to attracting other capital. Secondly, I think in terms of having engagement in these jurisdictions. There's been a lot of criticism in think tank land and media about transactional foreign policy approach with the incoming administration. And I'd like to challenge that. I think we need more transactional approaches. If you're sitting across the table, well, first, if you're not being transactional, what are you being? I don't know what the what's the alternative, a philanthropy. Second, if you're engaged in that part of the world and you're in a transactional relationship, it sets the contours for this win-win kind of concept where either side can look across the table and see what's expected of the other, be respectful to one another, understand what the KPIs are, and hold each other to account. And that way we can kind of pull forward on this. But I think that is where government has a meaningful role to play.
And maybe just to build on that point, we had a discussion about is cooperation at a global level really important and required to get the mineral supply growing, or is competition in those more transactional relationships to bring about supply more important? Maybe to start with you, Frank, maybe on that, just to build. Do you think cooperation at a global level is required, or is actually more competition and real transactions?
Well, I'd like to look at where has global cooperation ever been successful? Very few. I can't really envisage too many things where the UN issues a statement and the world came together and moved things forward. I think what you'll see is either collaboration along regional lines, which really you can break that down based on shared values, whatever that might be, or based on true commercial expediency. Someone has something that we need, we have something that they need, and there will be a coalition of that based along those binding factors. I don't think there's going to be some kind of grand organization that's going to yield anything productive. It will be co-opted, manipulated, and watered down, where it will lack all credibility and therefore substance.
Perfect. Does anyone want to take the opposite view?
I just want to add to something that Frank said, and I think we're in the perfect location to have this conversation. I think one of the solutions is for long-term strategic players like the Kingdom of Saudi Arabia to partner with the Western public mining companies, which and provide the capital that they need with a longer-term vision. I think that would be a partial solution to compete against the likes of China.
Well, and the time to invest is now. I mean, we're sounding negative about this, but the opportunity set in front of us is tremendous because you have had a depressed price market, you've had markets constrained of capital, you have consumer demand that in the West is slower than anticipated, but is still ramping. And the clear supply fundamental analysis says that we're short many of these products, but the price hasn't reacted yet. So this is the time to invest.
To add to Mark, I think we have a couple good examples of where I feel, cooperation, collaboration, competition all play. I look at, the U.S. Development Finance Corporation has equity in TechMet, where the Qatari Investment Authority, QIA, also put in $180 million, right? So together, the Qataris and the U.S. government essentially both have ownership over a country that's doing projects in Brazil and South Africa and the U.S. and Europe, for a variety of key commodities. You have the Libido Corridor, which as a whole is a G7 initiative for $600 billion in infrastructure. Some of you in this room know Congo, despite its risks, is a very attractive mining jurisdiction because the copper deposits are 5 times global average in terms of quality and 10 times some Chile's ore grades, right? But $600 billion towards, global infrastructure in emerging markets, the U.S. is aiming to bring in $200 billion of that by 2027, and there is bipartisan support for PGI, right? So again, these are signals that when we co-finance and we work together in these projects, whether the Gulf, Africa, or the Philippines, we actually move the needle toward the dispersion of supply chains away from just China or Russia into a more healthy, diversified, basket.
I think a place where collaboration may be possible by the governments is really on the regulatory side. Having good, capable, competent regulatory bodies, being able to share that so that when they approach a project, when they look at the permitting of the project, there's familiarity what the asset is. Too many times we go into jurisdictions where the regulators really have to start on page one. So you end up trying to educate them as to what they need to actually know to permit the project. That ends up being a huge, laborious project. Even in British Columbia, in Canada, you know, a province that has had really over 100 years of the mining industry, a prevalent part of it, trying to find capable regulators that can take a look at what you're trying to permit, understand what the issues are going to be, is really difficult. So if there was some kind of collaboration on that part, I think a lot of the other downstream issues would solve themselves.
Okay, we have 2 minutes left. We're going to go rapid fire. Everyone, 15 seconds. What will be the biggest unlock to get mineral supply growing? Is it going to be financial market regulation and change and contracting? Is it going to be governments? Is it going to be kind of governments on cooperation or more on regulatory permit, regulatory building? Or is it going to be something else? Maybe starting with you, Mark.
You know, I think availability of supply is going to drive the markets at the end of the day. So it's really going to be driven by market reaction to the availability of material, and that's going to move the needle.
Again, it depends on jurisdiction in answering that question. I come from Canada, one of the most mineral-rich countries on the planet, and for there, in Canada, we have a policy problem. We need better policies. We need shorter permitting periods, timelines, and that's an incredible inhibitor to the development of minerals in Canada.
Private markets, I think, will be a key to the solution. You know, the public markets are driven by passives, which are crowding out active players. Active are going private. Private is where most of the long-term capital exists, and so I think that's going to be a very important part of that solution.
Excellent.
Okay, for me, we are facing the same challenges in climate change, energy transition, so we still need cooperation to find solutions, to give visibility to investors. But what will make a difference for the next few years for me is the technology advancement. That certainly will change the situation.
Ensuring that we're strengthening our demand signals for these, to ensure that I'm not adding to a global base metals surplus, that's going to further drive prices down and potentially risk shutting down a mine.
Finding pockets of long-term capital and establishing places like here in the Kingdom where there's dedication to that generational aspect of really what the mining industry needs to develop their assets.
Finally, Frank.
Yeah, I would say that, you know, as President Reagan said, if you want more of something, subsidize it. If you want less of it, tax it. I think you're going to see a prediction in the near term here, a collection of both of those to kind of drive this new kind of price discovery.
Perfect. Well, in conclusion, a lot of different parts of the solution, not one probably that will be able to achieve it all, but thank you very much to all the debaters today in coming up with a lot of different answers to these solutions and questions. Thank you.
Thank you.